Welcome to Investing Confidential. It is hours after the market closed and the news is going from bad to worse. In fact, there's a piece of news out there or some information out there, man, it is really bad and it's something to really be concerned about. But let's start with the tech earnings, okay? We discussed this a couple of videos ago, flagged that the tech earnings were coming out this week, Apple, Google, Microsoft, et cetera, Amazon. They weren't going to be good, and we were not disappointed, okay? Google came out, Microsoft came out, both disappointing. I don't know how the market's going to react in the morning, but the futures are already down. Both stocks are down. Apple's to come, so is Amazon, and I don't think they're going to be as, this is going to be the same type of situation. They're not going to be good. So let's talk about Google here. So the most important thing, again, read the news, folks. Don't listen to the brokers. All the brokers are saying, oh, we iterated our buy. There was this. Google's operating income. This is how they generate their cash. The operating income was down 17% quarter on quarter. I'll say it again. Operating income down 17% quarter on quarter. The guidance isn't good. Who knows what the stock's going to do tomorrow? It doesn't matter, folks. This is not good. And these companies are going to continue to suffer. You know, Google was hit by weak ads in YouTube, all product fees across the board. I mean, imagine your operating income. This is not financial engineering you could hide through earnings per share. This is operating income down 17%. Not good. Microsoft, again, just as we called it, weak FX, the weak bookings, FX related. They also had numbers that were not good, and the guidance is also not good. So don't know how these things. They're down right now in the post market. Don't know what they're going to do in pre market, but most likely you're going to see weakness across the board because again, the big ones coming, folks. Apple. What they actually report is not relevant. What the guidance is going to be very relevant. So, given you had weakness in ads. In Google, big knockdown across the board and all kinds of fees, and you had FX-related headwinds and other weak bookings in Microsoft. Hard to believe Apple's going to show better than expected numbers. And Apple is the one stock that has held up. So there's a lot of money there that if they don't come out with better than expected numbers, they're going to run for the hills, and this is going to take the entire market down. So just keep watching these Apple numbers. But man, the big news out there, or the big information out there is something that I mentioned a couple of weeks ago when I was in London. This UK pension situation, as I said before, was a tip of the iceberg. Now we're learning, finally, we're seeing the Fed is reporting, or at least people are reporting, the Fed is sitting on huge paper losses. And it's not just the Fed. Okay, every central bank in the world is sitting on massive paper losses. And you say, well, they're paper losses. No. It doesn't work like that. The Fed has filled holes in the Treasury. The Fed, was sitting on huge gains because they were knocking the yields down to zero. What does that sound? They're sitting on big bond holdings and they're putting yields to zero to make their bond holdings go up. What does that sound like to you? That's manipulation. But now it's all reversed. Now there's a big loss. Bond yields are up. Prices are down. It's a disaster because now the Fed needs about $80 billion from the Treasury as opposed to giving the Treasury about $100 billion. What does that mean? The Treasury is going to have to sell debt at higher yields. Here's where the dominoes are going to begin to fall. By the way, if someone were to do an accounting of the Fed's balance sheet right now, I could tell you the Fed is technically bankrupt. But it's not just the Fed again. All central banks that have been doing QE, this craziness that never worked, by the way. QE never worked, by the way. I hope at some point someone takes away Ben Bernanke's awards and just calls it for what it is. This QE, this helicopter money, whatever they want to call it, it never worked. And now we're going to have hell to pay here because now the Treasury needs to sell debt at higher yields. So they've got to refinance debt that we have already. So their cost of the interest costs are going to go significantly higher. They've got to sell debt to fill holes, and it's a major issue. It's going to again exacerbate this hole the Treasury has, exacerbate the amount of money that they have to pay on interest, and the interest expense is going to keep going higher and higher and higher. Because remember, it's not just the bonds they have in the portfolio; they have the duration of the Fed's balance sheet is down to, I don't even know, less than 2 years, a year. I mean, all this debt's going to have to refinance. It probably averaged about 50 to 60 basis points. It's going to be 200 basis points. Imagine, again, it's the same thing. If you had a mortgage, and think of it, the Fed is like you have a mortgage. Your mortgage is a 2-year mortgage at 50 basis points. And then when you got to refinance that mortgage, you got to pay 3%, 2%, whatever it is. It's a nightmare. Okay, so this is happening all over the world. It is just the beginning, folks. It's not just, it's the Fed. People are calling the Fed the way it is because we have a little more transparency than most countries, but it is going to happen everywhere, and it isn't good. Okay, it isn't good. And now we have another really, really frightening trend. Foreign investors, you can see here, are rejecting our bonds. Okay, they're no longer buying, they're no longer funding our bond market. They're no longer funding our U.S. government. They're getting out of bonds. The U.S. dollar being so strong is hiding this. But this is really bad. Okay, this is really bad, because if we go to the market with bonds and foreigners aren't interested, we're going to have to keep raising the rates to sell those bonds in auction. That's how the Treasury auctions work. Okay, this is not good. It's a nightmare. Okay, it's not just good, it's a nightmare. And obviously our Fed officials, our Treasury officials, the White House are just staying away from this. But luckily, others are reporting it, and there's transparency here, and we're seeing. But again, it's happening all over the world, so we're just beginning to see these dominoes begin to drop. Let me just mention about why this is not going to be a short-term, why this is only not a short-term thing. It's going to continue for a while. Social Security, they just announced an 8.5% increase. Okay, it's inflation. I understand that. You have to do it, but this Social Security is massive. Okay, it's just going to add to inflation. It's going to add to the fact that the inflation in this country is sticky. As we talked about, I'm going to show you why inflation is coming down. But as I said before, it's not coming down to 2% where we're going to see some kind of pivot. It may come down to 4 or 5%. It's going to stay there. It's going to be impossible for the Fed to cut rates with that kind of inflation. Impossible. So they may have to stay raising rates slightly for longer, or just holding rates at very high levels for longer. Again, not good for what I talked about with the Fed. Not good for foreigners buying bonds, actually rejecting our bonds. This is very worrisome. And it's not good. So let's talk about some housing data. I mentioned that housing data was going to come out. It wasn't going to be good, and it's not good. Okay, look at this housing data. Housing prices are cracking. Okay, this is good for inflation, but certainly not good for the institutions that hold on to houses, and also for people who have borrowed against their homes. So this is the anecdotal evidence says we are in for a crash. Okay, look at, again, more evidence. Zillow rent index, rents are coming down. They're just the evidence is there. I've heard just recently on a news report saying, oh, rents are very sticky, they're very high. This is on CNBC and local news in New York. Rents are very high. It's rent inflation. Don't believe these people. Don't believe the realtors. There is tons of inventory coming on the market, rental inventory. Again, if you rent or if you're looking to buy, just have patience. Rent for a year, rent for 2 years. These things are coming significantly lower. Rents are falling. They don't believe what you hear. Rents are falling again, but that's the positive note is it's going to bring down the headline inflation, which is very good. But again, rents are sticky. But here's the real reason why rents are gonna come down. Again, bucking the trend of the media. Look at this. This is work hours to rent a specific dwelling. Okay, so what this shows you is how many hours you have to work to rent a house. We're at all-time highs. Okay, this is unsustainable. This is not good. This is crazy for inflation. It's not good for consumers. It's not good for the economy. And rents, as you can see here, rents have to come down significantly So don't pay those high rents. Go somewhere else. Do whatever you have to do. But rents will come lower and you will get relief. This is bad news for anyone involved in housing, etc. And but good news for inflation. But again, it's not going to. It may knock the inflation rate down, 40-50%. But even at 5%, we're still going to be at ridiculous highs. So good news, but it's not great news. Now let me talk about some global stuff, because I always talk about global stuff. Look at here, global PMIs, Purchasing Managers Index. These are forward looking. It looks at what's happening in the economy. That's what's really like. Is the economy strong? Remember, I mentioned this the last time. PMI above 50 means your economy is growing. PMI below 50 means it's not. Means there's trouble. These PMIs are weakening across the board. Okay, look at the numbers. Okay, there's a few countries doing okay, but across the board on a global basis, and China's not up here, but China's weak. These numbers confirm recession. End of story. Global PMI numbers confirm recession. And adding to that, again, we saw some EU consumer confidence data coming out. Look at these. I mean, again, I told you, this is the largest economy combined. It's the largest economy in the world. Their consumers have no confidence. That means they're not going to buy cars. They're not going to buy Apple computers. They're not going to buy expensive software. This is going to affect everyone. So globally, the situation is not good. And finally, to add to this malaise, okay, good word there, malaise, China new housing starts. Again, confirming that this Chinese economy is extremely weak. The numbers are just staggering, okay, relative to the past. This is the sector that drove the Chinese economy for 20 plus years. What does this mean? What does this all mean? It means global PMIs, EU consumer confidence, China housing starts equal one thing: weak economy, weak U.S. earnings to come. Okay, investors look out for the future for earnings. That's all that matters with the market, except when you have crazy times. But usually it's about earnings. There is no way, with all these factors going on, that large cap companies, the companies that have been driving the market, including tech companies, are going to be able to come up with strong earnings in this kind of global economy. So if you're a trader, you can trade the rally that we've had. Maybe it continues for a little bit. You can trade these rallies. But if you're an investor, as always, be careful out there.